Welcome, everybody. It's June 11th, the market update desk with Scott Riley, NMLS 157524. What we have some news that broke this morning. In addition, we'll break down the CPI report that came out today, which gave us some hope for some better market information and rates. So, the US and China have reportedly agreed to a general trade framework. Now, this deal would allow for China to release and send the U.S. much needed rare earth elements in exchange for aerospace parts and semiconductor programming tech, which we would be sending to China. This agreement is being well received in the markets. In addition, I believe they're stating that they're going to be less restrictive than what came out last week on Chinese students coming for college. Later this afternoon, we also do have a very important 10-year Treasury note auction. Looking at that, it's going to be very important to see where we're getting the buyers from and what the bid to ask price is going to be. Now, the CPI, the Consumer Price Index for May, showed that overall headline inflation rose 1/10 for the month, which was a tenth better than the market was expecting at plus 2/10. And year over year was actually better also than the market planned on. Inflation year over year rose from 2.3 to 2.4%, but the market was expecting a 2.5% number coming out. Now, this was pleasantly surprising because we stated earlier we were concerned with the replacement numbers that were going to be dropped off from last May and what was replaced this May with the 1/10. Last year was very, very small. So the differential from what dropped off last year to what actually came in this year was less than what was expected. Now, helping the headline inflation was a decline actually in prices for energy and gasoline. On the other side, food prices got us, and they rose significantly and were actually responsible for upwards of half of the total inflation in the headline report. Now, the core rate, which strips out the volatile food and energy, also increased 1/10, but that was 2/10 better than what the market planned on at plus 3/10. So a lot better news there than what we could have had. Now, it does not appear that tariffs were captured within this report yet. Again, it was interesting listening to CNBC talking about at some point we're going to get the tariff impact. Well, we've had 3 reports now, and we still haven't seen it hit. Could it be that businesses still have inventory at lower cost when they produced them and are reducing margins not to pass them along at higher cost to consumers? That's going to be a question. Most likely, the tariff impact is not going to be captured as much as many had feared, anticipated, talked about. This is most evident within new car prices. They've actually decreased 3/10. So there's the talking points of politics, media, and others that are out there. We're just not seeing the impact of tariffs, at least yet, of what many had talked about and were so concerned about. Now, overall, shelter was also very well behaved. It was reported up 3/10, with rent constituting 2/10 of that, and owner's equivalent rent was up 3/10. Helping us was lodging away from home, which is a very volatile number. That actually fell 1/10. Overall, shelter is up 3.86% year over year and has been falling. We've talked about this lag effect and catch up to what real costs are for shelter. If we were to take real-time numbers, we'd probably reduce inflation by upwards of 7/10 to 1/10. So it's nice to see we're starting to get some impact of that in the data. Now, when we look at all this, the Fed is really driving down into lower timeline effects of inflation, such as the headline 3-month run rate fell from 1.5% to 1%, and the 6-month fell from 3% to 2.6%. In addition, core 3-month dropped from 2.1 to 1.7. It's a pretty big drop. And the 6-month fell 2.9 to 2.6. The run rates are very telling and show that ahead of the potential tariff impact, it was very tame, and we're not seeing the tariff impact of what it was. Now, it's true that tariffs could, at some point in time, impact us, and they're just not showing up in the numbers yet. But it's been, like I said, 3 different reports now. But unlike inflation, it's not persistent and is a one-off, one-time price increase. So there's a chance we're not going to see what the media and markets had been so up in flames and concerned about. Now, with inflation looking very tame, especially on the 3 and 6 month basis, the Fed really needs to start looking at cutting rates ahead of potential a recession. Remember, they play behind the ball rather than in front of it so much that it does get frustrating for when we're seeing it. They could do this cut or multiple cuts and still have room to be restrictive because we're in such a restrictive stance right now. Now, the World Bank, its global growth forecast dropped from 2.7 to 2.3%. And for the United States, dropped from 2.3 to 1.4%. Um, so those are a little bit better forecasts than what they had before, but they're still obviously going in the wrong numbers. Now, mortgage purchase applications week over week grew 10%. Rates came down a little bit. We're in buying season. We're not going backwards, everybody. We're moving forward with volume of transactions and median home prices. Now, 10 years looking a little bit better today. It's down 3 basis points to 4.436. In pre market, before we got the CPI results, it was actually up at 4.04 when I was watching this morning. So the market liked what we saw, and let's hope we can keep it going in tomorrow's PPI report. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan, 616 293 2189. Have a great day.